You are one market crash away from losing everything if your wealth is trapped solely in stocks and bonds. In 2008, gold prices spiked while the S&P 500 plummeted, proving that traditional diversification is a lie. By swapping just 10% of your portfolio into vintage wine or blue chip fine art, you insulate your net worth from systemic collapse. These are the three overlooked asset classes the ultra wealthy use to stay rich while everyone else panics. And the third method, it is a total game changer that most financial advisors still refuse to discuss. Grab a glass of water, get comfortable, and let us get to it. Think about your current portfolio. If you're like most investors, you probably have a mix of index funds, maybe some individual tech stocks, and perhaps a high yield savings account. That is a solid foundation, but it is entirely dependent on the stability of the public markets. When the S&P 500 takes a hit, your entire net worth takes a hit. This is where alternative assets come in. They do not move in sync with the stock market. They are uncorrelated, meaning they provide a critical safety net when everything else goes sideways. Let us start with the easiest win, physical gold. I am not talking about buying gold stocks or exchange-traded funds. I am talking about owning the physical metal. The history here is incredible. During the inflationary peak of 1980, gold reached record highs, protecting investors who saw the value of the dollar evaporating in real time. A study by the World Gold Council found that over the past 50 years, portfolios with a 5 to 10% allocation to gold significantly reduced volatility without sacrificing long-term returns. When you hold an ounce of gold, you are holding a hedge against currency devaluation. The best way to start is by purchasing sovereign coins from a reputable dealer. Avoid numismatic or rare coins at the beginning because their premium price is based on scarcity, not the metal content. Just get your hands on a 1-ounce American Gold Eagle or a Canadian Maple Leaf. It is tangible, it is portable, and it is a piece of history you can actually hold in your palm. If you want to start small, you can buy fractional coins weighing a quarter or a tenth of an ounce. Once you own that first coin, you will realize that you have moved from just playing the market to actually owning wealth. Okay, so that is the first level. It is simple, it is reliable, and it is accessible to anyone today. Now, here is where things get interesting. We are moving into the world of fine art. Ever wonder how the wealthiest people stay wealthy through recessions? They treat art like an asset class, not just a decoration. Between 2000 and 22, the contemporary art market outperformed the S&P 500 by over 170%, according to data from Masterworks. That is not a small margin. That is a massive discrepancy that most investors never capture. Of course, buying a Picasso original would require a bank loan the size of a small island. But you do not need to be a billionaire to participate anymore. There are modern platforms that allow you to purchase shares in high-value artworks. You are essentially buying a piece of a Banksy or a Basquiat. You do not have to store the painting in a climate-controlled vault. The platform handles the insurance, the storage, and the eventual sale. When the piece appreciates and is sold at auction, you get your proportional return. It is a sophisticated way to access blue-chip assets that were previously locked behind the doors of private galleries. If you're finding this breakdown helpful, hit subscribe. I drop deep dives like this every single week. If this is clicking for you, a quick subscribe really helps me keep making these high-quality guides for you. Okay, so that works great. But what if I told you there is something even better? Something that combines passion, appreciation, and a market that is fundamentally different from everything else? Welcome to the world of fine wine. This is the one I have been saving for you. Most people laugh when they hear that wine is an investment. They think it is just a hobby for people with too much money and an expensive cellar. But look at the numbers. The Livex Fine Wine 100 Index has consistently provided stable returns over the last 20 years, often with less volatility than the equity markets. Why does this work? Because the supply is naturally finite. When you produce a vintage from a specific vineyard in a specific year, that supply is fixed. As people drink the wine, the inventory decreases. The bottle becomes more scarce. The demand stays high and the price rises. It is the purest example of supply and demand economics I have ever seen. My friend Julian started with a modest collection of Bordeaux in 2014. He spent about $5,000 initially. Today, that same collection is valued at over $15,000. He did not touch the stock market. He just bought bottles from top-tier chateaus and waited. You can start with a wine-focused investment fund, or you can build your own physical collection through reputable wine exchanges. It is a long-term play, certainly, but it is one that offers returns that are entirely detached from the daily drama of Wall Street. Once you see it this way, you can never unsee it. This shift alone could protect your capital better than almost any other asset class I know. So there you go. 3 real ways to build an alternative investment strategy. We covered the tangible safety of physical gold, the explosive growth potential of shared fine art, and the unique supply driven stability of fine wine. That third method alone, that realization that scarcity drives value in a way you can literally touch, changes your entire financial picture. You are no longer just a passive participant in the markets. You are now an active manager of a diverse, resilient, and sophisticated portfolio. If you got value from this, please share it with someone who is looking to level up their financial game and make sure you are subscribed so you do not miss the next video. I have a really special deep dive coming next week on the hidden risks of index fund diversification that nobody talks about. Stick around for that. See you in the next one.